Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous?
It's Friday. Welcome to Modern Investing Techniques, episode 67. I'm Patrick in Vancouver. Today is June 5th, 2026. Friday wrap-up. Let's see how the week played out and what to watch next. Quick reminder, everything we discuss here is for education and entertainment. The practice investment of the day uses simulated trades with no real money. I'm not a licensed financial advisor, and this isn't financial advice. Always do your own research before putting real money to work. Stronger than expected U.S. hiring data raises the odds that rate cut hopes fade. So Canadian investors holding rate-sensitive dividend payers in TFSAs should review duration exposure this week. The S&P 500 closed at 7,584, up 0.4%. The NASDAQ Composite finished at 26,831, down 0.1%. The TSX Composite rose 1.2% to 35,217. May non-farm payrolls came in at 172,000 against an expected 85,000, with upward revisions to prior months. That data keeps pressure on longer duration assets while equity sentiment stays mixed. Are we beating the NASDAQ this week? The numbers show nan, so we cannot determine the weekly alpha yet. With the data now in, let's break down exactly how to act on it. Non-farm payrolls act as a high-frequency gauge of economic momentum that directly shapes sector rotation decisions. When actual hiring exceeds consensus by a wide margin, as it did today, markets typically reprice the path of interest rates higher. That repricing boosts financials and value stocks while pressuring growth names. To apply this, pull the latest NFP release into a simple spreadsheet and compare the surprise versus the prior 3-month average. Tilt a TFSA allocation toward banks or pipelines only if the beat exceeds 50,000 jobs. And volume on financial ETFs confirms the move. This approach worked well in 2023 and 2024, when repeated beats kept financials outperforming growth during the hiking cycle. The main risk is that revisions can flip the narrative within a month, so always size the tilt below 10% of the portfolio. That same discipline shows up in today's practice investment decision. This is a simulated trade for educational purposes only. No real money is involved. Today's pick is none, monitoring only. We are waiting for volume-confirmed setups after the jobs data. The catalyst is the May NFP beat of 172,000 combined with upward revisions, which creates uncertainty around the rate path. We are watching financials for a close above the 20-day moving average on volume exceeding the 20-day average, but current levels show no such confirmation. Entering without volume risks the quick fade seen in recent partnership and earnings trades, so the maximum acceptable loss stays at zero by staying sidelined. Skipping a trade when the catalyst lacks volume follow-through preserves capital and reinforces the discipline of waiting for multiple factors to align. The absence of a qualifying setup is itself an active decision that protects the portfolio from low-conviction entries. That same discipline shows up in yesterday's trade. We simulated buying NVO at $45.39 on Monday's open and exited at $43.75 on Friday's close. The position lost 3.61%, or $36.13 on a $1,000 position. The launch catalyst produced no sustained follow-through once broader market volatility from geopolitical headlines took over. This is the exact scenario where our earlier rule about volume confirmation would have helped. The lesson is clear. Rule require both a fundamental catalyst and a volume spike above the 20-day average before committing capital to healthcare launches. NinjaTrader offers futures charting, automated strategy backtesting, and direct broker routing in one desktop application. The free version's advanced order types and market replay feature lets retail traders practice execution on historical data without capital at risk. Intermediate futures traders comfortable with leverage should download the free tier and run at least 1 week of simulated trades before going live. If today's momentum strategy interests you, NinjaTrader is exactly how you would screen for setups like this. Goldman Sachs lifted its S&P 500 year-end target to 8,000 on a strong earnings outlook. Add a small S&P 500 ETF position on any pullback below the 20-day moving average while keeping overall equity allocation below 70%. 19.2% of workers carry 401k loans in the first quarter of 2026. Rising loan balances signal household cash flow pressure that could weigh on consumer discretionary spending later this year. Trim consumer discretionary exposure in non-registered accounts and rotate toward defensive dividend pairs inside TFSAs. Retirement balances fell in the first quarter amid Iran-related volatility, highlighting sequence of returns risk for near retirees. Review bond ladder maturities in RRSPs and ensure at least 2 years of withdrawals sit in short-term fixed income. Across 33 simulated trades, the win rate sits at 58%, with 19 wins. The cumulative P&L and average return per trade are not available in the current data. Our AI analysis is learning from patterns around catalyst fade and adjusting entries accordingly. Now, here's something that most retail investors get wrong, and it cost me money before I figured it out. Imagine you added a Canadian bank stock to your TFSA last quarter, expecting a 4% yield. Your brokerage shows the dividend credited, but the actual after-tax advantage only appears when you compare eligible Canadian dividends against foreign ones, inside versus outside registered accounts. Eligible Canadian dividends receive a gross-up and dividend tax credit that eliminates tax inside a TFSA or RRSP, while U.S. dividends still face 15% withholding even in those accounts. Most retail investors overlook that the credit is wasted in registered accounts, yet becomes valuable in non-registered accounts. The pro tip is to run a quick comparison in your brokerage's tax estimator. Move any U.S. dividend payers into an RRSP where withholding is reclaimable via treaty and keep Canadian dividend aristocrats in the TFSA. The biggest mistake with dividend placement is treating all yields as equal. Instead, always map the tax character of each holding to the account type before the next contribution deadline. Before we wrap, keep an eye on whether financial ETF volume confirms any rotation into banks or pipelines on Monday. That's it for today's Modern Investing Techniques. The resources page has links to everything we discussed. Subscribe and share with someone who wants to go beyond index funds. See you tomorrow. And before you go, this show is part of the NARA Network, a family of daily podcasts covering tech, science, markets, and more. If you enjoyed today's episode, give Planetarian Daily a listen. Daily breakthroughs in science, health, and longevity. You can explore the whole lineup at neuranetwork.com. This episode used AI voice synthesis of my voice. Editorial selection and analysis are my own.
Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous? Do you ever stay awake, counting sheep like all the time? What's your life like? What's your purpose? When's your birthday? What's your sign? Are you down right now? Are you stuck up in the past? Are you still thinking about all the times that you didn't laugh?